Hello everyone. In this video, I'm going to explain the basic things that we see in open interest, especially for option tradings. Now in any broker platform in India, when you open the option chain, you see several parameters. And so in this video, I'm going to go one by one, the most important things, what do they mean? So first, what we see here is the strike price. The strike price is the price from which you can buy either a call option or a put option. Now here I am having the option chain of Bajaj Finance and it's trading around some value. Let's say it's around 8,850. And if you think the price is going to fall below, you can buy 8,900 put option, or if you think it's going to go up, you can buy 8,800 call option. These are actually fixed levels. You cannot buy in between. So these are called as strike prices. And next we see the volume. So the volume is the number of option contracts that is being traded today. So volume doesn't mean that those many contracts are written fresh today, because it includes both buyers and sellers. It's just telling me that how many were traded during this particular day. And we also have something called as PCR. If you see, it tells me that it's the put to call ratio, and if PCR is greater than 1, it means there are more put than calls, which means that market is having a bearish bias. And if PCR is less than 1, it means that the puts are less than the calls. There are more calls. So that's usually a bullish sentiment. And if PCR is around 1, that means the market is kind of neutral or undecided. It's like a doji candle. And now let's say if the price is around 8,900 and we see that the PCR is 2.7, that means that there are 3 times more put options than calls at this strike price. Next, you have a column open interest. Open interest is the total number of active contracts, like how many are still open and not squared off. It's not same as the volume. Volume is the number of option contracts traded today, while open interest is the number of active contracts that are still open and not squared off. And it tells me where the crowd is sitting, where they are holding their position. And so now let's talk about the option Greeks. These are the values that tell us how the option premium moves. For example, in the same broker platform, I can see the option Greeks. First we have the delta. This tells me how much my option price will change when the actual stock, the Bajaj Finance, will move by 1 rupee. So if delta is 0.89 and Bajaj Finance goes up by 1 rupee, my option will also increase by 0.89. It will not go by 1 rupee but only by 0.89. So higher the delta, you are closer to the money. For example, if you have out of the money option, if the Bajaj Finance is trading around 9,200 and you take 9,500 call option, which has a delta of 0.2, that's far out of the money. And so if the stock moves by 1 rupee, your option will barely move, and it will move by 20 paise. And next we have the theta. It's the time decay. The time decay is about how much option loses its value every day. So it's always a negative number. Here -8 means that if the price doesn't move or is range bound, your option will decay 8 to 9 rupees every day, irrespective of the price movement. Unless your strike becomes at the money or in the money, the price keeps decaying. So if you buy an option and stock doesn't move, your premium just melts like an ice. And so that's why option sellers love Theta. They make money on this value Theta. And next we have Vega, which is the volatility gain. This tells me how much my option premium changes if volatility increases. If Vega is 5 and if market volatility goes up by 1%, then my premium will also go by 5%. 5 rupees. So the Vega is, if it is 5 and volatility goes by 1%, you multiply, that will be the rise in your premium. And this is great for option buyers, because when there is big events or news or some market event happening, Vega will increase, and so volatility will increase and the premium will jump very quickly. And so option sellers want higher theta, while option buyers want higher Vega. And there is also a value called IV, which means implied volatility, which is the market fear level. This tells me that how volatile the market expects the stocks to be. And there is number like 21%, 23%. It doesn't tell me any direction. It just tells me the range. Higher the IV means more expensive the options will be, because there is more uncertainty, and so the premium will be very expensive. And so I hope you learned something. As a option buyer, you want higher delta, higher Vega, and low theta. And as a seller, you want high theta, low delta, and stable IV. And remember, this video is for only educational purpose. I'm not a SEBI registered advisor. Please consult your financial advisor before making any trading decisions. Option trading is very risky. Trade safe. Thank you very much.